Hey guys, welcome to another episode of Wave. In this episode, we'll talk about how you can build a simple portfolio, a simple crypto portfolio that is well diversified across sectors, selection, and size. Why this is important if even if you're a beginner or a tenured investor and your portfolio is concentrated among just maybe Bitcoin or just Ethereum or just Dogecoin in some cases, then most likely you're either sitting on a lot of risk, or you're sitting on a portfolio that is not really riding the wave because there's a lot of upside in many other tokens, right? So, as an investor in cryptos, you should have a pretty well balanced portfolio that can give you the highest possible returns with the lowest possible risk. We'll talk about one simple one right here and how you can create that in less than maybe 10-15 minutes. So the first big aspect is sector. If in case many of you are not aware, cryptos are not one sector. Cryptos have several subsectors. There is DeFi, there is NFTs, gaming, metaverse. There are infrastructure tokens. There are foundational tokens or like layer ones, layer twos. So your basket or your portfolio should be well diversified across all these sectors. Second is the selection. What is your list of tokens? How many should be there? We'll talk about that, and size. Size in terms of the market cap of these tokens. Why is that important? We'll look at that as well. So there are 6 points that you should probably keep in mind while you're getting into the crypto investments. These are losing, betting, TAM, platform, timing, and follow-on investments. Right? What are these? We'll look at it. Now, nobody likes losing money, right? If any of you have had experience playing poker, uh, crypto is sort of like that because you might not get it right for every bet you make. There's a good chance that you might lose some money. So you should know when to exit, when to maybe trust your gut instincts and stay on, uh, when to look at what are the fundamentals and then continue to stay on. But what you should get used to is losing money. There is a high chance that some of your crypto investments can go completely bust. There's a high chance that some of them might not really give you any returns at all. You'll be lucky if you get back what you invested. And there is a good chance that some tokens might go 2x, 3x, 5x, 50x, 100x, depending on what you invested in. So while all this is great, making money is something that everybody is happy with. Losing money, not so much. Tune your mindset so that you can adjust to it in case it does happen and you don't feel too bad about it. Right? The second really important thing is make many bets. Right? Don't invest in one token. Don't let your portfolio be concentrated with just like one, two, three tokens. You need to invest in a number of tokens for you to take advantage of the growth that is really happening there, and also spread your risk across many tokens. And in this, I would like to point out the larger the spread, the better the results. Right? I always like to compare crypto investments to VC investments into startups. Right? If you look at this data on the right side, it shows how smaller the portfolio. Like in this case, there's a fund with 15 companies. If you see their returns versus the fund with over 100 companies, the returns are just phenomenally different. Right? Why is that? It is because the probability of a company succeeding and becoming extremely large is very less, right? Maybe 1 to 2%. So that also means that if you invest in 100 tokens, then maybe one or two of them might give you that 1000x, right? Maybe 5 to 10 will give you that 50x. Maybe another 20 or 30 might give you like 2x, 3x, right? Maybe like 30 or so would even like not give you anything. So the ideal way is for you to pick up a good number of investments. It need not be 100, of course, but definitely not five. Right? You need to balance it out. I would say between 20 to 30 is a good number for you to start with if you're in your first or second year in crypto investments. TAM is a very important thing. What is TAM? It's a total addressable market. Uh, TAM for Bitcoin is like maybe $11 trillion. If you consider Bitcoin can replace gold, Bitcoin can become a global reserve currency. Bitcoin can maybe be used for remittances and so on. If you look at all those use cases, TAM for Bitcoin is almost 11 trillion. Right? You need to look at different crypto projects, see what is their utility, what is their TAM, and if that project has a huge TAM, then it might have a potential to be a billion or $1 trillion success. and that would essentially help you evaluate whether this is a good token to invest or not. And I'm not sure if any of you have heard of this. There's an interesting story of the California gold rush, where when gold was found in California, a lot of people went down to California to try and dig up some gold, but most people made no money. The people who did make the money were the ones who were selling the tools. Um, in very similar fashion, I would say in cryptos, right, invest in platforms, right? Platforms like, for example, don't invest in an end NFT, but invest in a platform that helps you mint NFTs. Right? An NFT project might not necessarily become big, might fail completely, but the platform is still going to be used. So the probability of success of a platform is much better than the probability of success of a individual end project. So in whatever tokens you're looking at, try and invest as much as you can into platforms rather than end products. And then there's timing. Right? Timing is the most important thing. Timing is absolutely important in anything that you do. Right? You cannot have, I don't know, most people would not want to have breakfast items for dinner. As simple as that. Right? Timing, in fact, accounts for is the most important factor in some research that was done on 200 companies. About 42% of the timing accounted for 42% of the success of these companies. Right? Then there's follow-on funding. So remember how I told you to maybe think of investing in larger number of tokens. So the idea is don't invest your entire amount. Let's say you want to invest X amount of money into cryptos over a period of 1 year or 2 years. Don't invest the entire X amount within in one shot, right? Why invest in a smaller amount, like let's say 40% of it into your basket of tokens, right? Into the 20, 25, 30 tokens that you decide to invest in. uh, Watch them for a while, see how they grow, and see the ones that are becoming early winners, and double down on your investment in those. The tokens that are not really doing well, you can exit them, right? Or you can probably leave it, in case they spur up later on. You can look at that. In this way, you can deploy the rest of your funding into the early winners. How would that look? Maybe a year after you invested, your graph might look something like this. Some tokens might, like the red one here, some token might just go completely bust. It might be lower than what you invested in. Some tokens might be around the same price as you invested at. Some tokens might start seeing that early rise, right? You need to evaluate the roadmaps or what is happening with this token. Are they getting more users? Once you evaluate these things, then you get some sense that yeah, this token is doing well. And when this is sort of happening, right, where the token is just rising, there is some early success, that's when you should double down on your funding into these tokens. You can put an additional amount of funds that you had earmarked for the follow-on funding, put that into these tokens, and you will get, hopefully you will get a rise in prices like this. Right? So in this way, your portfolio is better secured and has a higher chance of making more returns for the same amount of money. Now, what would an ideal portfolio look like? Um, Probably something like this: around 30% into Bitcoin, maybe 30% into L1 and L2 tokens, 20% into high growth tokens, which have a fairly decent market cap already, and 20% into micro tokens. This is a rough portfolio that I would sort of try and look at for even myself, right? You could try something like this. Now, why Bitcoin or why 30% in Bitcoin? It need not be exactly 30%. It could be 25%, 35%, whatever. But around 30% is what I would say. It's because Bitcoin is the king, right? It carries the entire crypto market. Bitcoin is stable. It is the foundation of the portfolio. Stable in reference to other cryptos, of course. Bitcoin is safe compared to other cryptos. We have seen the market today has over 15,000 tokens, but Bitcoin still commands a 40% market cap almost. So it is relatively safe compared to the other tokens. And there is still a lot of upside considering Bitcoin can probably go up to $11 trillion market cap. There are many research analysts who have suggested that Bitcoin can go up to at least half a million, 1 million kind of a price point. There is a lot of upside, right? So Bitcoin as a foundation of your portfolio would be ideal. Now 30% L1 and L2 tokens, L1 tokens like Ethereum, Cardano, Algorand, etc. L2 tokens like Polygon, Loopring, Polkadot, etc. These are the general purpose blockchains, or the blockchains on which other dApps are being built. So definitely, like I mentioned, of the platform strategy, this is on the lines of that, where no matter what end the app might fail or not, this one will at least have some utility and it will keep rising. 20% in high growth tokens. Right? This must be your third sector or third part of your portfolio. There are different sectors within cryptos like DeFi, infrastructure, metaverse, lifestyle, gaming, NFTs. I've mentioned a few of the good ones in all this. These tokens have proven themselves in the last couple of years of their existence. Not all of them have been there for so long also, but yeah, in the last few years or few months in some cases, they have proven themselves. They have reached a decent market cap of at least 200, 300, maybe a billion or more in some cases, and they still have a lot of upside. Like these tokens would help you grow your portfolio with lower risk. And there are micro tokens, right? Micro tokens are very small, maybe less than 200 million in market cap. These tokens will get you that 50x or 100x, right? The idea of putting in at least 20% of your portfolio into this is to try and bet so that you can maybe get that 100x on at least one of the tokens. I've given some examples here. Do your own research, figure out what are the micro tokens and what should your end portfolio look like. Now, four simple rules for you to follow. One is don't chase the gains. What does that mean? Uh, when the market is increasing, when there is a media hype, right? Everybody tends to invest at that point of time. Don't do that. Right? It's a lot of FOMO, but don't do that. Don't run after the market. There is a good chance that you might just be investing right at the top, and you'll be left with a negative portfolio for a while. So don't absolutely do that. Do all the research. Invest in tokens which have fundamental value, which might not the price might not be indicating that today, but in the long run it definitely will. So do your own research and invest in the tokens that have a good fundamental value. Right? Follow the 30-30-20-20 kind of rule, and hold on to your portfolio for a while. Bitcoin cycles usually last these 4 years, but depending on their halving cycles. Um, so even the crypto markets have seen this 4 year cycle of going up and down, and if you invest, hold on for at least 3 to 4 years, right, for you to get reasonable returns on your portfolio. Never panic sell. I know there are times when you invested maybe 100,000 into some token and it became 8,000, 9,000, 10,000. You just left with 10% of your value. Don't panic sell. And it's not a loss till you sell it. So do not panic sell. Fourth one is be greedy when others are fearful. Today the markets have crashed so much. Most people would be, running away in the opposite direction. But this is when you're supposed to go and try and buy it, because you're getting, I don't know, Bitcoin at 50% discount today. So look at it that way. Try to be greedy when others are fearful. Right? These are the four rules that I hope all of you live by, and this can help in having a great portfolio. I'll give you one small example. So on our website wave33.club, we have created a small portfolio or basket of tokens for first-time investors. You can go through it. We have given a high-level information about what are these tokens, why are they important, what is the growth that we see in them, and so on. And we've created a portfolio for you right here. If you want to spend little time, this could be a great way. This could be an indicator for you to start your research on. We have about, I think, 14 tokens or 10 tokens here, right? 10 tokens for you to start off with. These cover everything from large market cap tokens to smaller market cap tokens to sectoral diversification. All the rules that I mentioned in the video today, we have tried to follow all of them and give you a portfolio of 10 tokens that try and cover as much of that as possible. This could be a great way for you to start off. So do check out our website wave33.club. You will find more such baskets of tokens depending on what you want to invest in. You can find the link in the description below. Um, do like and follow our page for more updates, for more interesting concepts like this. Stay tuned for more portfolios, more analysis on cryptos, and a lot more that we have planned for you. Thank you so much.